Chuck Carnevale. I'm the Chuck in the Markets Up Chuck. And today's blog was talking about what's the business worth. And the real idea here is that the real true value investor, and I like to think more of a value growth investor, understands that what the business is worth is really a lot more important than how the market may be treating it. And the second factor to that is that the true value investor is investing in the business and not the stock. So I'm going to start out with Waters Corporation, show you a picture of a company here. I have about a 15-year history. Actually, it's more like a 14-year history. As you can see, Waters has consistently grown earnings at a very, very attractive rate. By the way, this company is engaged in analytical instrument manufacturing, designing, selling, and servicing. And through their Waters division, they kind of specialize in high-performance liquid chromatography and ultra-performance liquid chromatography. Very sophisticated company, but the point is, I think it's a great example of how the market can be really mispricing stock. So as you see in the black line here, the monthly closing stock prices, in the long run, the stock price clearly followed earnings. But there was a period starting in 1999 where the stock got massively overpriced. And see, the true value investor, and I think having the advantage of this tool here, this blue line with the white asterisk is the normal PE ratio, which correlates to the earnings growth rate in this example. This represents the true worth value, as I talk about in the blog, of the company. When the stock price got so overpriced like it did, through the, getting into the fall of 2000, it inevitably came back to its true worth value. Also, when it got undervalued, like it did in March of 2003, it was coming back to its true value. And you can see during the recession, the stock had the normal knee-jerk reaction. But I do want to point out that this company is a very solid company. We've already seen the stock price recover and beginning to come back to its true worth valuation. But the point is, the real investor, value investor owning a company like Waters was not spooked by this. In fact, if anything, this would be a great time to be adding to the position when the stock price got low like it did in these examples, and not panicking and selling, because the true investor knew what the business was worth. Now here I do want to make a distinction about price volatility. Here's a case where price volatility is actually following very erratic earnings. I'm really not talking about that. It's very difficult at any point in time for a company like USG. It's one of their main divisions is US Gypsum. That's probably better known for that. Very, very hard to determine what the true worth value of a company like this is. The same would also be true of this next company, which I really don't know anything about. I just chose it because of the chart. AVX Corporation. You can see when you're looking at a company like this that the stock price does still correlate to earnings, but it's very, very difficult to ascertain what true worth value is. I'm really talking about companies like HDFC Bank, which, by the way, is an ADR. It's an Asian bank. It's one of the best-run Indian banks. But I did want to show the picture because I think it really tells a story. It doesn't matter where the business is domiciled. Ultimately, the operating results or the cash flow generation of the earnings of the company generate and determine where the price is going to go in the long run. And as you can see here, starting in March of 2007, the bank got massively overvalued for reasons that we won't get into today. Then it ultimately came back to value. Now, I do want to make a point. I believe any time the stock is touching this line, it would be an attractive time to be buying the stock. Of course, had you bought it, back here in the fall of 2008, you would have paid, a price that looks like around $53, $54 a share. Actually, it's even as high as $80 a share. But down here, if I can hit the dot, it was a lot cheaper before it fell all the way down to $45 a share, in February or March of 2009. I'm only showing $51 because I only have monthly closing prices here and not the prices in between. But the point is, when it got undervalued like this, then it came back to valuation. So if I'm owning HDFC Bank, when I see the price up here, I'm very concerned and I'm ready to sell. On the other hand, if I see the price here, I'm very comfortable. I think it's very reasonably priced at that point. When I see it fall down here, I don't panic and sell. I actually get excited and consider buying more because ultimately I know that it's the value of the business that really matters. And the last example I want to cover is Colgate-Palmolive. Obviously a stalwart company, 11% grower. As you can see, it's historically traded at a price-earnings ratio of around 20, 21 times earnings. It's a high-quality premium company. But I do want you to see that it was very clear that when it got overvalued back in 1999, investors who, were buying it or holding it from this point forward saw 1, 2, 3, 4, 5, 6 years of poor performance, even losing money. You know, it went from a high of 65 all the way down here to 45 over that 6-year period, yet the company did well because ultimately, you know, these particular investors weren't really aware of what the business is worth. They should have known that $65 a share, Colgate was only worth 33. However, anytime you buy it when it's reasonably priced, those are good times to buy it. And you can see the recession, you know, Colgate did extremely well going through the recession. Their earnings growth was very strong, very healthy. It's a terrific company, as I already mentioned. And, you know, the price got very low. You can see how much it's already recovered. So the bottom line is, invest in the business, and then, you know, use some, you know, common sense fundamental analysis, which is ultimately, as these charts are based on, you know, looking at cash flows and how the cash flows drive the value of the company, and other things like return on invested capital and so on are things that you look at. But the point is, when you go through the fundamental process, know what your business is worth. When the market's behaving badly, you don't get spooked out, or you don't get aggressive when you should be, you know, fearful, or fearful when you should be greedy. Now, this is Chuck Carnevale. This is Friday. I'll be taking the weekend off as usual. I appreciate all of you for tuning in this week and look forward to talking to you again next week. Have a great weekend, and thanks for listening.